Good morning. I'm honored to be here this morning to address this forum, which is recognized globally as a leading venue for the discussion of financial technology and regulation. As you all know, technology is changing the financial industry, and these changes are enabling new business models around the world. But this morning, I would like to share with you a vision of how financial technology can change the lives of the poor and accelerate the growth of developing economies. I lead the Financial Services for the Poor team at the Bill and Melinda Gates Foundation. Our foundation's motto and guiding principle is that all lives have equal value. You don't need to squint very hard to see the relevance of financial inclusion in this mission. After all, financial exclusion is a driving factor of global poverty and inequality. About 2 billion people worldwide lack access to the formal financial services that you and I take for granted, such as savings, payments, insurance, and credit. Yet, most people, poor people, live very active financial lives. Though they transact in small amounts, the number of transactions they make is quite large. They buy food, pay doctor's bills and school fees, have multiple sources of income, and borrow and lend money through complex family and social networks. To get by, the poor can be very creative about pulling together informal financial tools. But they mostly rely on cash and illiquid assets like jewelry and livestock. And their informal networks are not always reliable. As a result, they face constant risks, limitations, and hidden costs. Needless to say, this can kick the ladder out from under anyone trying to climb out of poverty. That's why the Bill and Melinda Gates Foundation has made financial inclusion a priority. To put a human face on it, let me tell you about a dairy farmer I met in Kenya a few months ago. He has 2 cows and 3 SIM cards. He's recently gotten access to mobile payment systems, and he saw the benefits quite clearly. He now has a faster, more secure way to be paid for his milk. He no longer has to rely on couriers to collect cash from his customers, which is a good thing, since those couriers would sometimes run away with his money. This not only cost him his cash, but also required him to once again go through the hassle of finding someone else to deliver his milk. All that is now in the past. His customers pay him directly with mobile money, and he pays for some of his supplies electronically as well. He was able to take out a small loan and make incremental repayments through his bank's mobile money service. This farmer is very happy with all this, but there's still one problem. He still has those 3 SIM cards, which he has to swap in and out of his phone every time he works with a customer using a different payment network, or whenever he has to make a loan payment. Now, could you imagine having to pry open your phone and pop in a new SIM card every time you wanted to call a friend who was on a different network? That'd be absurd, right? Well, that's more or less what this farmer has to do. But it's even worse than that. He also faces transaction costs to shift money between payment systems. In addition, having balance sitting in multiple accounts makes it more difficult to monitor and manage his money. All of this may make some people give up on digital payments and go back to cash. I tell the story of this Kenyan farmer because it illustrates both the great potential of digital financial services for the poor and the hurdles that still exist. We believe that digital technology is the only way to deliver the goal of financial inclusion. Digital technology can help reduce transaction costs to near zero and make it possible for businesses to reach far-flung populations in whole new ways. It can enable the poor to use, store, and manage their money easily and safely, and for governments to improve the efficiency and scope of social welfare programs. According to the McKinsey Global Institute, digital financial services could make it possible for approximately 1.6 billion people to enter the formal economy for the first time. This would be a breakthrough for the world's poor. The same study estimates that digital financial services would add $3.7 trillion to the annual GDP of emerging markets by 2025. So we shouldn't limit ourselves to seeing digital financial services strictly as an anti-poverty tool. It's an extraordinary catalyst of sustainable economic development across the board. But to get there, we need the right policies and the right participants, the right innovations, and the right infrastructure and investments. One of the best investments we can make is the development of digital payment systems. The foundation is often asked, why focus on payments and payment systems? Well, we believe that pro-poor payment systems can foster competition and drive innovation. They provide the rails that can be used to deliver a wide range of digital financial products and services. They are the foundation for helping the poor move out of poverty at scale. So what do these pro-poor payment systems look like? We think they have 5 key traits. They need to be accessible. They need to reach into the poorest neighborhoods and smallest villages. And they need to be easy to acquire and use, including by people who have never used financial products before and who may not even be able to read and write. They need to be reliable. Users' money and information needs to be both readily available 24/7 and highly secure, protecting against cyber theft as well as money laundering and terrorist financing. They need to be valuable. There needs to be a clear advantage for the people to use digital payments instead of cash or barter. They need to be affordable, really affordable, almost free for small-scale payments. But they also need to be profitable. We can only serve new digital financial services users innovatively and sustainably if these services are delivered by the private sector and if these service providers can earn a profit from their new users. So you're probably thinking, this all sounds great, but how can we make it happen? We studied this question at the Gates Foundation and with our partners, and we think there are 3 essential conditions of digital financial systems that can support the development of the pro-poor payment systems I just talked about. These 3 conditions are exclusive use of real-time push payments, a wider, more diverse range of financial service providers, and true interoperability among these providers. So let me explain what I mean by each of these and why they're necessary. I'll start with real-time push payments. So real-time payments enable both merchants and consumers to know immediately that a transaction's been made and that it's irrevocable by the sender. This is important if you want to replace cash. Push payments are those initiated through the customer's institution, unlike a typical credit card payment where the transaction requests come from the merchant's system and institution. And push payments reduce risk. A high proportion of credit card fraud stems from the fact that merchants initiate payments, and when merchants initiate payments, they introduce risk into the system. Many of you have had the experience of seeing that credit card charge from halfway around the world showing up on your statement. Much of the cost of payment systems goes to preventing this risk and resolving disputes. Push payments increase reliability and reduce costs, which helps ensure both the affordability and profitability of the system. What's more, push payments will enable an explosion in the number of businesses that can accept electronic payments, including in very poor and rural areas. Because banks no longer need to assess and bear the credit and fraud risk of merchants. This greatly increases the accessibility and value of the system. The second condition required is the introduction of a wider range of payment service providers into the system. Alternative providers are already revolutionizing retail payments in some countries. Ant Financial and Tencent are dominating retail digital payments in China. Most of you know about M-Pesa, the mobile money offering of Safaricom, which has greater digital payment volume than all of the Kenyan banks combined. And while they might not have reached the domestic scale of these three companies, fintech firms and mobile money operators are making significant inroads into retail payments in many countries in Asia and around the world. You may ask, why is it necessary to allow fintech companies and telcos and other types of businesses to provide financial services? Can't banks adopt these same technologies and reach the poor in a low-cost way? We think telcos and fintech companies have several advantages when it comes to serving the poor in a low-cost way and doing so at a profit. Companies like Tencent and Alibaba have platforms and infrastructure that already reach hundreds of millions of people very inexpensively. Telcos have agent networks providing voice and data services reaching into most towns and villages around the world. These companies have a huge cost advantage when moving into new service for their existing customers. In addition, they tend to have cultures of innovation and low-cost delivery, which enable them to pivot nimbly in response to changing market dynamics. Banks do not have existing relationships with very poor and rural customers, or reach into communities in which they live. So the full cost of serving these new customers would need to be recovered through fees for financial services. But while banks may not have a natural advantage in serving the poorest customers, they will continue to be the natural financial service provider for the companies and institutions that the poor would like to pay and be paid by. So of course, their participation in the system is still essential. Which leads me to the last of the three conditions that are essential to the development of a new pro-poor payment systems. And that's interoperability, the ability of customers to transact with any other customer, whether they use the same service provider or not. These kind of open-loop systems substantially lowers the cost and complexity of digital financial services and payment platforms. But here we face some real challenges. For example, the three innovators I mentioned above, Ant Financial, Tencent, and M-Pesa, are essentially all closed-loop payment providers, which means their platforms are designed to handle payments only among customers within their system. And that can easily create problems. Remember the Kenyan farmer with 2 cows and 3 SIM cards? His situation vividly illustrates the inefficiency associated with parallel closed-loop systems. True interoperability would allow him to have a single account on a single SIM card and interact with customers, merchants, and lenders on other systems at very low or zero cost. And by true interoperability, I'm not just referring to the ability to fund a wallet or tie a payment account to a bank account. It's much more than that. It's allowing a merchant or agent to have an account with any payment company and to exchange payments with customers from any other company. No barriers, no friction. Interoperability among a wider range of service providers is not easy. It's been the toughest hurdle for the financial service industry to overcome. But the potential gains of doing so are enormous, both for the financially underserved and for the financial sector itself. That's why our foundation has made technology investments directed specifically at building greater interoperability. While each of these conditions, real-time push payments, new business participants, and interoperability, are vital to the digital payment system, the true power lies in the combination of all three. No one has really managed to achieve this, not yet. That said, Asian countries are at the vanguard of things I've just talked about. I've already talked about the innovations coming out of China. India has also taken a leadership role in developing digital payment systems and other financial services. Its Aadhaar biometric ID system, the establishment of payment banks as a new class of financial service provider, and the linking of payments to ID or mobile numbers rather than bank account numbers have all combined to create an exciting platform for financial inclusion. And this financial system is at the heart of what's known as the India Stack, which uses open standards to promote presenceless, paperless, and cashless delivery of services across different sectors of the economy. The Philippines has also been a leader in this space. Banco Central Pilipinas licenses a new class of mobile money payment companies, and they recently launched a new payment system that includes both banks and non-bank providers. This switch will be augmented in the new year to include real-time push payments. And as you've been sharing this week, examples of exciting innovations and the potential for amazing progress towards inclusive financial services goes far beyond China, India, and the Philippines. For Asia and for the world, now is the time for action so that we can capture this potential. Governments need to establish the regulatory framework, policies, and incentives to help digital financial services flourish naturally. The G20's high-level principles of digital financial inclusion offer a blueprint on exactly how to do that. Regulators must define and regulate new types of financial service providers. They also need to adjust account opening requirements for low-risk accounts. But it's not just about opening systems and lowering barriers. While some risks diminish, new risks and challenges emerge. Supervising a wider range of market participants and protecting millions of new and often less educated consumers is no small task, and RegTech can play an important role here. Outside of regulations, governments can prime the pump of the new payment systems by digitizing G2P payments. Social benefit programs are particularly useful for bringing poor, underserved populations into the formal economy. Banks can view these new payment providers not as competitors, but as partners that will bring millions of new customers into the financial system, creating millions of new potential customers for banks and for their corporate clients. Traditional companies have the opportunity to rethink their business models. We're all familiar with the example of how small packets of shampoo revolutionized how consumer goods companies reach the poor. Well, low-cost micropayments could transform the way services are delivered to poor and rural customers. And fintech companies need to anticipate and respond to the rapidly evolving regulations and payment space to adapt their business models to new opportunities. A great example is how Google leveraged the new payment banks and payment infrastructure in India to launch Tez just this September. In October, the following month, 60% of the payments going through the Indian real-time payment switch, UPI, were initiated through Tez, as payment volumes through that switch doubled in 1 month. So what could an inclusive economy built on a strong digital payment system look like? It looks like subsistence farmers getting loans and insurance, as well as crucial supplies like fertilizer and modern agricultural equipment. It looks like families obtaining insurance and savings they need to provide for their own health, and thereby to remain in work or in school. It looks like students gaining access to loans and other funding for tuition and school supplies, and also to digital learning materials from around the world, either for free or via electronic micropayments. It looks like city neighborhoods and rural villages buying solar panels for the same daily payment that formerly provided them with kerosene for light. And it looks like an economy that finally begins to reflect the strengths and insights and priorities of women, who are likely to reinvest their incomes in education and health, factors that contribute significantly to broader economic growth for the entire nation. Ultimately, the Foundation's take on financial inclusion derives from the ethos I mentioned earlier: all lives have equal value. But there's another phrase that concisely captures our fundamental belief about financial inclusion. Everyone benefits from an economy that includes everyone. What I like about this phrase is that it reminds me and my colleagues and partners that everyone stands to gain from the participation of the poor in the formal economy. That should be our goal, and that is the greatest opportunity for fintech around the world. Thank you for inviting me to speak with you today. It's been a real pleasure to be part of such an illustrious event. And I invite all of you to join me in our goal to use financial technology to drive financial inclusion, create new business models, grow economies, and eliminate poverty around the world. Thank you.